So good afternoon, ladies and gentlemen. It's my great pleasure and honor to welcome everybody, the audience and our distinguished guests to our second edition of FIW Trade Talks. FIW Trade Talks is an online event series in which the FIW project wants to discuss recent trade policy issues with high-level international policymakers and economic experts in the field of trade and international economics. My name is Harald Oberhofer, and for the next hour, I'm your host of this session. And before I'm gonna introduce our distinguished guest of today, I want just to briefly present some organizational remarks that you should keep in mind for the remainder of this event. So first of all, FIW is a joint project, a collaboration of 4 universities in Austria with 3 research institutes, which aims at studying international economics topics and also promote this topic more into public audience. And this is basically what the Trade Talks should also contribute to. The project is supported by 2 Austrian federal ministries, the Austrian Federal Ministry for Education, Science and Research, and the Austrian Federal Ministry of Digital and Economic Affairs, where for the latter ministry, we are very grateful for providing financial support, making possible this FIW Trade Talks event series. Now to the organizational remarks. First of all, as already have been mentioned now in the chat, please post your questions in the Q&A section of Zoom. As a host, I will select your question after an introductory remarks of our guest, and we will gonna have a discussion of your questions in the aftermath of this initial presentation. Furthermore, the webinar, so the session will be recorded, and the record together with the slides that Professor Koopman is going to present today will be shared on our FIW website. Finally, after the seminar is over, you will receive an automated email with a short feedback questionnaire. Since we always aim to improve the quality of our events, we would be very grateful for any type of feedback you might have on today's Trade Talk. Now, I would like to move on and briefly introduce our distinguished guest of today. Our guest is Robert B. Koopman. Robert is Chief Economist and serves as Director of the Economic and Research and Statistics Division at the World Trade Organization. So he is the Chief Economist of the WTO. Prior to this, he served at many high-level positions at the United States International Trade Commission. So he has also very good insight into US trade policies. And Bob is also Associate Professor at the Graduate Institute of Geneva and a Research Fellow at the Center of Economic Policy Research, the CEPR, in London. Robert, it's my great pleasure to have you as our guest today. I'm very happy that you accepted our invitation. And now I would like to hand over to you for your input statement, and thank you very much once more for being with us today.
Thank you, Harold. It's my pleasure to be here. I'm going to go ahead and dive right into it, share my screen, and get started. Whoops, that's not the one I wanted to share, so hold on a second. Try it again. Well, are you seeing the full screen, or are you seeing?
I see the full screen, everything's
perfect.
fine.
Okay, all right. So I'm going to talk a little bit about trade in a time of COVID-19 and the future of multilateral trade cooperation, all of which on the latter issue is rather speculative. But let me start with where we are right now. And about a year ago, we saw what we thought was going to be an absolute disaster. We were thinking demand is shutting down. There'll be big and significant widespread supply chain shutdowns. Things looked very, very bad. And my thinking at the time, because I was charged with coming up with a trade forecast, was my thinking was it would probably be as bad, if not worse, than what we saw in the great financial crisis of 2008, 2009. We did a bunch of economic modeling, some simulation modeling and something called a CGE modeling, some macroeconomic modeling. And interestingly, I would say that the CGE modeling did a better job of predicting the next year's path than the macro modeling, because it captured something very important, and that was a shift in the composition of demand away from what we call proximity-related services towards consumption of goods, which are tradable. So from a trade perspective, we thought we might see anything from a 13 to a 32% decline. And what we ended up seeing was a much smaller decline, about 5.3% in 2020. Most of that in the second quarter of 2020, and the very extensive fiscal and monetary support and this compositional shift of consumers' demand, which was supported by those interventions, helped mitigate and bring about a rather quick recovery. I don't know if you can see my cursor here, but you can see a steep decline in Q2 of 2022, very rapid recovery, so that actually by the first quarter of 2021, we were already at 2019 trade levels. So that was very, very surprising, but very good outcome for trade, very good outcome for the advanced economies. And going forward, you can see that we expect trade growth on an average trend to not get back to the previous trend that we observed between 2015 and 2019, but to be on that trend line, but not be on that rate of growth, but not recover back to the trend line. The green line that gets us back to the previous trend line would be if there was extensive vaccinations globally and the vaccines are effective. That would stimulate trade growth and economic growth and get us back on track. If the vaccine rollout is slower than say what might be an average rate of vaccinations, and or the vaccinations turn out to be relatively ineffective, particularly against variants, then we could see trade growth slowing once again and falling back down and not recovering. But so far, it seems like we may be somewhere between this green line and the blue dotted line there. So the trade decline was much smaller in relation to the GDP decline. It was roughly 2.5 times the size of the GDP decline, while in the great financial crisis, the trade decline was 6 times greater than the GDP decline. And we've observed trade in medical goods and agricultural goods, particularly food security, critical goods, has been either very strong or very steady compared to 2019. GVCs, despite what you've been hearing in the press, have been relatively resilient compared to the great financial crisis. There are disruptions in supply chains, no doubt about it. And I would argue that much of that disruptions in supply chain, some are related to the health measures governments are taking that are limiting the ability of workers in certain areas, particularly in logistics related areas, but also in preventing some factories from getting back to full operation. But much of it's actually got to do with firms like me looking from April of 2020, sitting there saying demand's going to fall through the roof and cutting production and cutting orders, supply chain orders in anticipation of a big decline in production. And then all the supply chain firms in turn reducing their orders in production and that reverberating through the system. But then we see this strong recovery here and all of a sudden there are supply chain constraints because everybody cut back on production. Demand has spiked beyond what the expectations were, and supply does not respond immediately. Supply responds with a lag. So yeah, that's a quick overview. You can see here that for the past, in the lead up to the great lockdown, we had relatively slow growth of trade compared to GDP, ranging between less than 1 to about 1.8. Back here in the long 1990s, we had trade growth growing much faster than GDP growth, but I would argue that that was a unique set of circumstances. We had India, China, and European centrally planned economies all integrating into the global economy. We had massive liberalization, both multilateral trade liberalization, regional trade agreements, unilateral liberalization, liberalization of capital flows. All of these things generated a huge growth in foreign direct investment and trade growth, which I think is not typical of global integration. It was an unusual period, and anybody who thinks we're going to go back to that period, I think, is a bit mistaken. My guess is we'll see a return to globalization that looks much more like the longer term since the Industrial Revolution in the late 1860s to current, which would be trade growing about 1.4 to 1.5 times faster than GDP. I think one of the bigger challenges that we face is if there's scarring from this, particularly in investment and foreign direct investment, both domestic and foreign direct investment. Investment is very trade intensive. Investment goods are highly traded. Globalization has reduced their prices very significantly and increased the variety and the quality of these goods. So globalization's biggest mechanism has not been the elimination of tariffs and those little dead weight loss triangles that one might see if you do general equilibrium or partial equilibrium modeling, but it's the dynamic effects of the spread of know-how and capabilities through better capital goods, foreign direct investment, and firms spreading their know-how. What could happen as a result is scarring. On this left-hand chart, you see here the United States in the great financial crisis, where something called the Congressional Budget Office regularly projects potential GDP. You can see they had projected potential GDP, and that in the earlier 2000s that there had been the U.S. economy had been tracking that potential GDP very well, in fact, sometimes exceeding it without inflationary pressures. I could get to that if you want. But then the great financial crisis resulted in a huge decline of GDP and slow recovery. And as a result, CBO's revisions of potential GDP have been regularly downward. And this great lockdown will once again result in a shift downward of GDP below CBO's potential GDP. We'll see a faster recovery towards the potential trend because of all the fiscal and monetary policy in the United States. Now, we did something like this in 2013, looking at the drivers of growth in global trade and global GDP. And we did an optimistic scenario and a pessimistic scenario. The top lines here are GDP, the bottom lines are trade. The green line here is what actually happened. So you can see that our model did a good job of capturing the range of potential outcomes, but the real outcome was much closer to the pessimistic scenario. You can see this starts in 2012. So there was this slow recovery. The US here is an example. This is for the global economy on the right-hand side, but you can see there was a slow global recovery too. We didn't get anywhere near closing the gap with with potential. And you can see trade did a little bit better, but still remained in closer to the low scenario. What that means is when we go back and revisit these long-term projections, this blue line is going to fall down because capital investment's been weaker, and the starting point for the optimistic scenario is going to be with that lower capital stock. All right, so COVID-19, trade tensions, and global economic development. So I would argue the bottom line is that all those Trump tariffs had pretty small impacts in terms of the direct effects of the tariffs, these welfare, these deadweight loss triangles that one might study in international trade, intro to international trade. So loss triangles and a lot of moving around in terms of the political economy of producer surplus and consumer surplus. But the indirect effects are particularly potentially large, and the increased uncertainty affects the components of aggregate demand, particularly investment and consumption, and that can bring about this scarring. So the biggest effects are long-term, with a much slower shifting out of production possibility frontiers around the world. So while tariffs and raising trade costs cause a lot of trade diversion and some fragmentation of a fairly globalized economy, the negative investment shock lowers long-term growth. And one of our concerns is if there's a technology war that could fragment the world of digital economy into 2 or 3 spheres, China, US, and Europe, that could affect goods trade because of things like embedded 5G chips, limit the knowledge spillovers and foreign direct investment and those drivers of global convergence. So right now, COVID is the major driver that we're observing. Just keep in mind things like in global trade, so the trade war, you hear about trade conflicts and things like that. You know, US-China trade is 3% of the $22 trillion worth of global trade in 2017. Global automobile trade is 8%, so much bigger. A breakdown in global cooperation of tariffs, we estimated it would take 2% off global growth. That would vary quite a bit depending on the countries. Large countries like the US, much less affected than smaller countries like Australia and Canada. But global trade would decline by 17%. So, and if we included non-tariff measures and things like that, we'd get much bigger effects. So there can be big effects, but 2% of GDP is relatively small compared to what we've seen in the GDP decline as a result of the COVID crisis, which has been much more around a 3 to 4% decline of GDP. So the future could look quite different. I want to make this point. China's been undergoing rebalancing for a long time. Changing comparative advantage. One frustration for me with trade policymakers is they forget that comparative advantage changes. They imagine their economy either right now or, you know, if you know someone like Donald Trump, the 1960s in the United States, that was how the world should be, and anything that differs from that is because of other countries cheating. And yet what we've observed over many decades is that comparative advantage shifts around the world, particularly for certain sectors, and that changes one's trade patterns. And then there will be issues in the post-COVID recovery around Build Back Better and green, which I think could be very, very interesting. So I won't go through this very much. I'll skip it. It was the swift policy actions, $16 trillion in fiscal support, and another $10 trillion equivalent in monetary support. This was massive intervention to help with that quick recovery, as well as what we saw as this demand shift between proximity-related services to the consumption of goods in those advanced economies where demand was supported. I worry that this COVID stimulus in the Build Back Better could be the next driver of trade tensions, often global imbalances, and we see global imbalances growing in trade flows right now. China's back to running a big trade surplus, the United States running a big trade deficit. That typically results in protectionist measures and trade tensions, even though it's largely macro finance forces. Often it's trade measures that try to address it, and they're usually ineffective at addressing those forces that are driven by macro finance imbalances. So why might we see conflict? Many reasons. Unbalanced growth globally. So we've seen rapid growth in Asia for many decades, China in the last couple of decades, but we also see this regionally. So I used to work in agriculture in the United States, and for a couple of years, my portfolio was related to rural development. That had been an issue in the United States for the previous 30 years, trying to close the rural-urban growth gap. It had been unsuccessful. This was in the early 1990s. And here we are in 2021. Rural-urban growth in the United States is a big issue. It's a big issue in Europe. It's a big issue in many countries. So you get this regionally, you get it subnationally, you get it by sector, labor skill category, demography and households, many drivers, many margins of adjustment. Understanding the role of trade in this is very important. It's what I spend my life on. So, none of these are surprises to economists that that trade can have effects on these. But a challenge for economists is to tell the full big picture story. In other words, how's technology contributing to this? How is fundamental demography contributing to this? How is changing consumer preferences contributing to these things? Regional migration in the United States from the north and the northeast, north central and northeast to the warmer climate, largely because of improvements in infrastructure and air conditioning. Nothing to do with trade, but often attributed to trade. So we see big changes in technological change. We see big changes in trade flows, change in consumer preferences, economic geography, efficiency of labor markets, efficiency of property markets, market power. For me, my job is to put trade into the context of these forces. Many academics will look at very specific elements of that trade question. My job is to do some of that, but also then put it into the bigger picture here. I think I'll skip this slide. I've already talked about some of this. What are the forces that drive trade growth? Macro matters, what's happening to GDP. Only 25% of trade growth is usually due to changes in trade policy. 75% of trade growth is driven by fundamental GDP and macro forces, not trade policy. Why bother to look at trade policy then? Excuse me. Well, because that 25% can accumulate and you get compounded results. So it makes a difference. It's something policymakers can control. It's a good idea to pay attention to it. Here's some picture of the global imbalances. I'll skip that. In fact, I'll skip these last few slides. I want to stop with something called the level playing field here. There are many reasons. This is a big topic of conversation. You hear it in the G7 pronouncements. We have to do something to level the playing field and take action against, say, China's cheating. That's how they would describe it. I would argue that every WTO member is clever in trying to either get around their obligations or meeting their obligations. Many of those things result in unlevel playing fields. So the question is, could it be, natural bad design? Have you not invested in your infrastructure for decades and reduced your competitiveness? Have you not invested in education, institutions, things like that? Or are they being distorted by somebody, either decreasing the playing field to give them an advantage, or perhaps by some of your bad design or some of your actions where you've increased your domestic trade costs vis-a-vis your trading partners. So I think it's very important to understand this better. We're doing a big study right now with the IMF, OECD, and World Bank, trying to get a better sense of, what is the pattern of subsidies? How much are they distorting the level playing field? And can we get a sense of how much are those factors versus other factors that might just be more domestic in nature, or perhaps even something where global cooperation around climate change or global taxation might help with a cooperative solution. So Harald, I think I'll stop there. I went on for about 20 minutes and I think it's a good place to stop. So let's open it up for comments and questions from the floor or from you. Thank you.
Thank you very much, Bob. Very interesting, and I think a lot of topics for in-depth discussions. So I again just want to remind the audience, please post your questions in the FAQ section of Zoom, and I will incorporate your questions into our talk. But maybe since I had kind of a head start and had already the chance to have a look at your slides prior to the audience, maybe I want to start with a couple of questions, first more specific ones on your presentation, and then move on with some more kind of a general discussion. Maybe I want to start with one thing, due to the fact that we had the G7 summit recently, and also this policy in the US with the idea of this Endless Frontier Act, where actually US government now wants to spend 250 billion in investments into high-tech industries, and the G7 initiative that now tries to somehow counter China's Belt and Road initiative. I think that fits to the level playing story a bit, but also on this question that you raised on technology war. So what is your view on this actually? Are we now moving into this technology war, especially if you look at what happened the last couple of days in terms of policy initiatives from the Western economies?
Yeah, I worry very much about this. It's not just, by the way, concerns around, say, the West and China, but there are concerns within the West, right, between the US and EU in terms of their privacy levels. And it's not, I mean, if you had asked me a couple of years ago, I'd say the biggest chance for conflict would have been between the US and EU, even though we were seeing open conflict between the US and China. We saw some with the EU, but there's been long trade tensions with the EU. And part of that's philosophical differences around, say, the precautionary principle that the EU tends to follow, whereas the US tends to follow approach, and until it's proven unsafe, we assume it's safe, right? So I think, it's a complex issue. Right now, what we're seeing is a coalition or a move towards a coalition between Europe and the United States and other partners related to China. And, this is a very, very complex area. It's a dynamic area. It's not clear to me when you look at tech regulation. So forget the trade aspect. Just look at the regulation of technology. A lot of governments are trying to figure this out. Jean Tirole has, written excellent books and papers on the need to design a regulatory environment that's flexible and adaptable to a rapidly changing world. I find that in the trade area, that the world is changing more rapidly than the GATT negotiators in 1947, or right up through the creation of the Uruguay round, could have ever imagined, although those negotiating the Uruguay round should have seen it happening, because it was happening very fast. So I don't know, the answers to this. We do need better facts. We need to get a better sense of the regulatory environment and getting a better sense of sort of the legal complementarity of different approaches. And that's some research we've got going on here within the WTO. We're doing economic modeling around what might be some of the negative effects of fragmentation globally and slowing the technology spillovers and know-how spillovers. But we've also got to get a better sense of how big are these subsidies. And believe it or not, we don't have a very good sense. In some areas, we have better sense than others. Agriculture, for instance, perhaps fossil fuels. But, industrial subsidies such as those going to tech firms and things like that, who knows? I mean, the US announces a number that gives us maybe some neighborhood to consider, but how much of that is fundamental R&D versus reducing the cost of fabbing and producing particular kinds of technology? We don't know. The OECD's done some very good work around steel and aluminum with a very complex matrix to look at these different potential channels for providing support. But, if you believe Mariana Mazzucato, some of this stuff is, the government's taking care of either market failures or trying to find a cooperative solution and lead the private sector towards a better outcome. And I think there are some really relevant parts to her argument. So I think it gets to be very difficult to sort that out, Harald. But having a clearer view and having the facts, and then thinking about how do you analyze that data, those facts, and get insights, I think is, there ought to be a couple of PhD theses there, I think.
Thanks. Very interesting. And I would agree totally with you that well is very complex and gets even more complex over time. So will be difficult to figure out everything in a perfect manner, of course. Maybe related to this also, I found quite interesting that one of the scenarios you're talking about in your slides is this breakdown in global cooperation and everybody's moving to the individual optimal tariff level.
Yeah.
So there would basically be two questions on this. First, do I get this right, that would imply that smaller, more open economies would have smaller tariffs, maybe zero tariffs, while the US would always have some positive tariffs, at least on most of the goods. And of course, the questions related to this, and given that you're at the WTO, do you think this is in any way in line with WTO principles?
Well, no, it's absolutely not in line with WTO principles. But it did seem to be where I think the previous US administration's thinking was. We're big, the US is big. We've got market power. We should, come up with optimal tariffs, and that'll generate domestic economic activity. And, it's a very diverse economy, so a lot of flexibility there. So in our analysis, the US isn't very adversely affected by this. Its terms of trade gains offset a fair amount of the efficiency losses. But for countries like Canada and Mexico and Australia, it's pretty bad. The EU is another large trading region. We treated it as a bloc and it did okay. But the principle of the WTO is, you're trying to solve this prisoner's dilemma and create an environment where everybody lowers tariffs. I think people mistakenly assume it's zero tariffs. There are a lot of zero tariffs in WTO agreements, but that's, negotiators decide what level of tariffs they're willing to accept, and they vary by country pretty significantly. So, it's kind of a Bagwell-Steiger approach. Now, we've got some research that's currently under review at a journal that asks the question, is it time to rebalance the agreement from the Uruguay round? Because the world has changed since 1995, and a number of economies have gotten much larger and they're much bigger players in global trade, and that might argue that perhaps they need to take on more obligations to be consistent with this kind of outcome. So, one of the challenges is that the design mechanism and the of the WTO agreements is that it's hard to update them, particularly with a consensus-based decision-making process. There's very little incentive for countries to basically say, yeah, I'm ready to go back to the table and negotiate more market access. So I think there's some fundamental design issues. I think the principles, most favored nation, non-discrimination, those kinds of things, those are very powerful principles. But the design of the negotiating process, I think, is perhaps not keeping up with the changes, hence my invoking Tirol.
Yeah, I would also agree with what you basically mentioned in your presentation already, that we might talk much more about non-tariff barriers nowadays, and that domestic policies might play a much more relevant role as compared to the 47 years where tariffs were so high and everybody was clear about, well, just try to get the the tariffs down somehow.
Mhm.
Maybe related to this, so I'm already looking at a Q&A section, and since you're now mentioned this twice, with the world is changing faster than envisaged in the GATT, including the Uruguay round, I would like to just use this question or come up with this question from the audience first and then move on to other topics. Would be with your statement that the world is changing fast as compared to policy, basically, where do you think is the need for new or adapted WTO rules the biggest?
Yeah, well, I think there's the existing rules that I think need to be revisited and updated. But there is probably the biggest issue is new areas. So there's areas that have been hanging around, like agriculture, very important, from the Uruguay round through the Doha round, and more can be done there. But it's quite interesting the way trade negotiators look at, if I could, I'll focus a little bit on the agriculture agreements. I worked on those for the Uruguay round while I worked for the US government. And the idea of us economists at the time was, hey, there's a lot of bad behavior in agriculture, particularly in the US and the EU, Japan and Korea also, some others. A lot of subsidies, distorting markets, resulting in excess and surplus production, dumping on the global marketplace, reducing prices in developing countries, things like that. Let's find a way to limit that. Let's try to find a way to limit it in those countries that are already doing it. And let's try to find a way to prevent the bad behavior from starting in other countries. Because the political economy of that bad behavior is, once it starts, it's very, very hard to discipline and get rid of. So that was what we economists were thinking, right? But trade negotiators will now sit there and particularly those from developing countries, and say, those fast emerging developing countries, hey, US, EU, you got lots of support you can give to agriculture. We want to do the same thing. And so the agreement's unbalanced. You need to let us do that. You need to reduce your bad behavior, and you need to let us do more of that bad behavior. That's inconsistent with the underlying economics of why it was done. And that's also, you could think of that example as applying to other areas for subsidies, right? So we economists would basically say, decouple that from production, right? If you want to make your farmers richer, just write them a check. The US did that, by the way, something called freedom to farm. But within a few years, there was a budget surplus again in the United States, very briefly, by the way. And farmers were basically, and conservative politicians were saying, that's socialism. That you're just writing them a check, right? And that's socialism. So suddenly, what was a well-designed economic policy is thrown out. It's painted as something that it really wasn't. It was efficient economic policy, relatively efficient economic policy. But for those developing countries that want to get into this business, as an economist, I would say, write your farmers checks. Write them checks. And if they say, well, food security, I'd say, well, open global markets help much better with food security. I mean, you can have a drought domestically. If you have a drought domestically, you're going to want to import, right? You're going to want to rely on that market. If there's are you going to produce every year in case there's a drought in some foreign market? That, if you think about a portfolio of production and diverse production, that doesn't make a lot of sense. So I'm not sure where the food security angle comes in there. I can see some emergency stocks that make sense, but trying to build up domestic production when the global market is already doing a reasonably well job of meeting those needs, I would question that. And then if you look forward at climate change, some of those countries that are very, very interested in food self-sufficiency, it doesn't look so good for them in terms of climate change impacts on their production capabilities. And some big producers like the United States, it doesn't look so good for them. They may not be such a big net exporter. All right, I wandered there, but I hope that was responsive to the question. New areas, climate change, very important. Green transition, sustainability, I think thinking more about, and inclusiveness, I but inclusiveness from a trade perspective is really about lowering trade costs so more small firms can do that. But most of the inclusiveness, I think, would argue it's a domestic policy issue about making sure the gains from trade are more widely shared with the general population.
Thank you. Maybe just to add on this, I think this developing economies divide will also be very important with respect to climate policy, my point of view, right? Because for understandable reasons, developing economies would argue, well, you have polluted so much CO2 over the last decades, and you're rich now, and now you're rich and everybody should save the planet somehow. And we have never had the chance to develop our own industry somehow. And I think this will also be one of the major challenges in coming up with global climate policy, because clearly without global coordination, we will fail anyway in this respect, at least in my point of view. If I may be so dramatic.
By the way, Harald, this is where thinking about compensation is very, very helpful, right?
Yep. Indeed.
So what is the compensation mechanism? And, I think there should be one that helps with developing countries build the capacity or get access to the technology to help with a more green transition. And that spills over into the developed countries. But a lot of focus seems to be on, well, let's preserve our clean industry and tax the dirty industry. And it doesn't seem to be very much on, well, let's help clean up that dirty industry in the other country, right? And I think their policymakers need to get that in mind because of the global commons question here.
Yeah, thanks a lot. Maybe since we already talked a bit about developing and developed economies, I have another question from the audience, from Julia. She wonders about your 25% statement on the contribution of trade policy on increases in global trade flows, and she wonders whether this number, in your point of view or based on your analysis, is mainly observable for developed economies that are already very open and trading and have a lot of history in there, or would you think that this, just in her view, rather small share that trade policy can contribute would also be valid for developing economies?
That's a very good question. That's an aggregate number. And I know empirically, just doing back of the envelope calculations in the United States when I was there, I had to demonstrate to USTR this fact that trade grows regardless of whether or not you've changed your trade policy. So we looked at changes in US trade flows between a group of countries for which we had trade agreements and a group of countries for which we had no changes in trade policy. And interestingly, trade growth was 25% faster in that group of countries for which we had trade agreements. There was growth, rapid growth, and more. It was just 25% faster in that subset of countries for which we had trade agreements. And that convinced them that, oh yeah, okay. So we do get trade growth regardless. But the number I'm using largely comes from an IMF study in the WIO in probably 2016, 2017, one of their chapter 3 research studies that says 25 to 33% of changes in trade growth is explained by policy changes. And I tend to go towards the lower end, 25%. But the bigger your tariffs, the further you are away from the global production frontier, the bigger your gains from liberalization. So that number would likely be much larger in countries far from the frontier with big distortive tariffs. They'd gain more. Of course, they'd have more adjustment costs too.
Yeah, so maybe just to add on this, because Julia was also specific on that. So you would argue that, for example, the African Continental Free Trade Agreement or the Regional Comprehensive Economic Partnership Agreement would do more benefit due to the fact that you have more also low-income countries included, especially in the African trade agreement, as compared to the 25% from Islam.
Particularly the African one. RCEP already, a lot of those countries are already integrated pretty extensively, and a lot of their trade is already pretty low tariff. So when I look at that agreement, not a big economic impact there. Good one, take it. It's a dollar bill lying there, but for Africa, it's probably more like a $20 bill lying there, or even bigger. But you mentioned non-tariff measures. There can be lots of ways that you can substitute protectionist behind the border measures for lowering your tariffs. And we still don't know exactly where Africa is going to go on this integration path. So I'm pretty optimistic. I think it's definitely a step in the right direction. But I think we have to wait and see when the rubber really hits the road.
Yeah, thanks. Maybe one last somehow very specific, well, it's not that very specific, I would say, question, and then maybe we move to the broader picture, is also from the audience, and it's about the relationship between bilateral trade, global trade, and monetary policy. And the specific question would be, do you think that the US issuing the US dollar in any way helps it run a trade deficit, as it does, at least when we talk about goods trade, right?
I think it does. Gita Gopinath and co-authors have written, I think, pretty extensively on the dollar's role in both trade and debt. It hurts in one way, in that appreciation of the dollar does not necessarily, or depreciation does not really affect its trade balance all that much, right? Since the vast majority of goods in the global marketplace are priced in dollars, it's a wash for the US when the dollar changes values. But I think where it really helps is more in the sense that it's able to sustain deficits longer, because people want dollars in order to undertake those trade transactions. And so the US has a pretty strong market for the dollar and can pretty much always issue debt. It pays it back in dollars. So if the dollar appreciates or depreciates, it doesn't really matter very much. So I think it does give it some ability, but I wouldn't overstate it. I don't think it's, I think it hurts with its ability to adjust, but it works through that macro balance, finance balance, much more, being able to run twin deficits than the direct effect of prices of imports versus exports.
Thank you. I would agree with this kind of assessment on the role of the US dollar for global trade, and especially for the US, for sure. So maybe let's at least try and start to look a little bit in a more broader perspective, and to start with, well, of course, the elephant in the room for future trade and trade policy is the question on climate change and climate policies. And so here I have another question from the audience. The next big trade issue is the role of trade in climate crisis. What can the WTO do with respect to concerns, as for example, raised by Joseph Shapiro? And what do you think, this is also directly now going into your work as a WTO chief economist, how much of a challenge do you think will bring those new national measures that are most likely to come up, like CBAM, so cross-border adjustment mechanisms for taking into account differences in border CO2 taxation across countries? And so what's your view on this with respect to a multilateral trade policy regime as introduced via WTO?
I think it's important that one recognizes that the WTO has many flexibilities in it. Something something called Article 20 that allows countries to take actions to support domestic social objectives. So one can think of climate change there, although you have to meet certain principles. So it's not easy, but you can. And the principles are good principles to try to meet. But more broadly, so the Shapiro, is this about, the fact, is it that trade policy has been biased towards brown industries?
Yep.
Or is it the fact that that the act of trading has emissions? I mean, those are two aspects of his work that that I'm familiar with. So.
Right. I think maybe we can see if we get an update on this question. But I would think first of all on his work showing that recent trade policy or last type of trade policy have been biased towards non-very climate-friendly trading.
Yeah, yeah, and I would say that that's an accident of economic development in history that should be fixed. And members had started negotiating around an environmental goods agreement and couldn't find a solution. Sounds like many of them are now turning back to that and having it broader, not just environmental goods, but also environmental services, which are incredibly important, particularly in this modern technological age of being able to assess better what just refinements in domestic economic activity can do to reduce emissions. And some of that knowledge and capability as a service provider from some other country coming in and doing that kind of assessment. But yeah, fixing the brown goods tariff bias is something members should do. And now, thanks to Joe's work, we've got insights on that wasn't well known. So putting those kinds of facts out there, I think, is very helpful. And we're doing some analysis on that. We're looking at carbon border adjustment mechanisms. We're looking at carbon taxes. And we're thinking about it from a microstructural view and from an inclusiveness view of developing versus developed countries. How might the different mechanisms work? What are their distributional effects by sector, by country, by level of development? And what kind of compensation mechanisms might work better than others? Just to try to help inform negotiators around the debate. There's a lot of literature on this out there, and a big challenge for us is trying to bring it together and synthesizing it and then filling in some of the gaps. But we're working on that, and we'll be working with some partners. And I think we're a bit behind, and part of the reason we, the WTO Secretariat's a bit behind on that, has been a philosophical issue here at the WTO where it's a member-led organization. So the Secretariat historically has been pretty quiet. Much of our best research often goes into working papers or conference papers. So we generate the knowledge, try to make it available. But with the new DG, she very much wants us to put this knowledge out there and then bring members around it to have that discussion, members and stakeholders, so others doing that research. And I'm very excited about that. Of course, I don't have much longer here, but I'm very excited about getting started down that path and making it a conversation. And the way I view it is adding oxygen to the debate, as opposed to having the debate occurring in a vacuum or with very little knowledge oxygen.
Yeah, great. That's really very interesting to me. I think I also had the impression when reading the work of Joseph Shapiro that this might be a game changer and showing how important clear and nice research is about bringing out facts, which a lot of people have not been aware of just. And I would also agree now it's on the policy side to fix it. Once the evidence is out there, then you will say, well, that might be, that's not good. We have to change that. And that's great. Now, and since you already started talking about the new DG of WTO, and our topic of today is what next for the global trading system, let me just rephrase it a bit in a very general framework and ask you what is next for WTO? Since we have now already talked about so many different aspects, right? And as you said, it's a membership-led organization, and we have superpowers around the US and China and the EU and Japan, and everybody's kind of doing own policies in a very bilateral way, I would say.
Yeah.
So what is the future for the WTO?
I find it very, very interesting. You know, I've been here about 6 years. And so I'm not, by my peers' standards, my fellow directors and senior staff here, I'm a newbie. I'm relatively new and perhaps a bit naive. But the way I see it is, you know, most of the problems that we face these days, big problems, are really collective action problems. And we need cooperative solutions to them. But the way negotiations work here at the WTO is it's mercantilistic exchange of market access. I'm only going to do something that's good for me if you do something that's good for me. Otherwise, I'm going to withhold that. I'm not going to do it for free. And I think that complicates matters. So that's one element. There's this sort of the design of the negotiations and the need for consensus. And that on the need for consensus, one of the fundamental differences is there's quite divergent views of the role of trade in economic development. So, you know, if you ask China, China's going to tell you, China and some of the Asian economies, they're going to say, man, trade has been absolutely important. And I would say that indeed, Europe and the United States and some other rich countries opened up their markets and made their demand very accessible to any country in the world, essentially, if you can produce things at the right regulatory technical standard. But you know, and so the U.S. is going through this populist moment where it's questioning the role of trade, being an advanced economy. My view is, you know, trade's contributed to some of the challenges, but they're more fundamental, and it's domestic policy that really needs to get up to speed and fix those things. There are some things they can do in trade policy that would be very helpful, but most of those are progressive. But some countries, and I'll point out India and South Africa, they don't necessarily see open trade or opening up their economies and taking on more commitments as beneficial to their economies. They think that other countries should do that and open up access to their markets, but that they don't have to, you know, they won't really benefit. They'll benefit more from, you know, having policy space to undertake domestic industrial policies than bringing in foreign direct investment and technological know-how and spillovers. They'd love to do some of what China did. They just don't have the market size to do it. But anyway, so I could go on about this, but I think I'll stop there.
Thanks. Yeah, we would have maybe we would need a few more hours to talk about all those issues, but maybe I want to stop this discussion here with one final question before we are out of time, and I think this fits also nicely into what we just started on WTO, which is about the current plurilateral initiatives about e-commerce, domestic regulation, subsidies, investment, and so on and so forth. What can we expect from those in terms of growth and trade would be the first part of the question, and the second one would be, how should or could they be better incorporated into the WTO rulebook?
Well, that's a very complex question, and I'd have to bring in the lawyers, and the lawyers would say, we can't tell you because it's up to members. But I do see, if you look at the history of the GATT was really about plurilaterals, like-minded countries taking commitments forward and not everybody having to join into them. A big element of that from a economic principal perspective would be trying to make sure that any effort like that was applied on an MFM basis. So even if you're not in the club, you benefit from it. But if you look at RTAs, you see this in the regulatory space. A lot of what they wanted to do in behind the border regulatory coherence is it's just naturally MFN. I mean, you can't discriminate when you make a regulatory change typically. And some of these areas that are being examined in these plurilaterals are kind of close to that. When you look at e-commerce and things like that, it seems to be much more about regulatory commitments behind the border things. It's not about reducing tariffs, right? So yeah, it's a complex question. Members have to work it out. I don't think they're in a position yet to resolve it, but I think it's a natural place where the organization has come given the tensions around the consensus approach and the world changing very rapidly around the organization.
Thank you very much. When looking at a time, I think we need to stop here. So first of all, Bob, I would like to thank you very, very much for being with us today and for sharing all your knowledge and insights into very complex topics with us today. This is really very much appreciated. Before concluding this session, just two more remarks, again, organizational ones. If you want to have another event on WTO, then join us in less than 2 weeks on Monday, 28th of June. We're going to have an FIW lecture on the topic of WTO 2.0 from lawyers. So that's also fits what you mentioned last. So from a very important perspective when we talk about deciding trade policies, obviously we need to learn to understand the lawyers as well. And my final remark is please follow us on Twitter. Check our website. You're going to see all the events that are recorded. You can find all of them at our website. And with this and with the nice weather outside, at least in Vienna, I would like to thank everybody for joining in today, for being with us. Enjoy your late afternoon. All the best. Stay healthy. And we're going to see us in the next FIW events. Thank you very much. And again, Bob, thank you very much, especially for your time. And
thank you, Harald. Thank you.
Bye, everybody. Thanks.